assets that show less volatility.
I see. And the other assets are what, the bonds or something else?
Bonds, exactly. Yeah.
Is the goal here to try to really reduce the chance of being hit by a black swan?
Yes.
Is what you're talking about sounds very similar to, I don't know if you heard of Nassim Taleb. He wrote the book on black swans, and he mentioned this as one of the strategies, the barbell approach.
Yeah.
Overweight, very conservative investments like bonds, and then maybe 80-90%, and then the 10 to 20% you put in much higher risk assets.
That's very much the theory behind it. You also this fund also tried to keep the drawdowns low, simply because of the mathematics behind it, right? Because if you have, for example, a 50% drawdown, you need 100. You need to make 100% just to get back at break even. Exactly. Yes.
So, what were some of the assets that the fund was investing in on the riskier side of the equation, with a smaller portion of the total assets, like individual stocks or options or what high risk type assets?
So this fund was quite straightforward in terms of assets, because this was basically the fund was just investing via ETFs into equities and into fixed income also via ETFs. So there were no leveraged products involved or derivatives.
During this time, you're also able to trade your personal account without any restrictions?
That was one of the reasons why I joined this company, because it was possible. For many other companies, it wasn't possible. So they already tell you this during the interview, that you cannot trade any of your positions, or you sometimes also have a minimum time horizon. For example, you have to be invested for at least 30 days in an asset, and you cannot hedge it, and so on. But here it was possible. That was one of the reasons why I joined the company as well.
Did you learn anything at the company that you later incorporated into your own personal trading?
At this company, not too much, because it was a very long-term strategy and it was mostly in equities and bonds. Where I worked later, I worked also at a proprietary trading company where they did quite a few short-term strategies, and that was a little bit of an eye-opener for me, especially in terms of with regards to my own strategy that I was using still.
Tell us, why was it an eye-opener?
It was mostly an eye-opener because that's where I learned what it means to have, there's no official technical term for it, but mostly they refer to it, what it means to have a structural edge, which I would define as understanding your asset in such a way that you know where it's most likely going to go in the midterm. And when you look at equity indexes, for example, if you look at the whole history, you will see that they mostly in the US tend to go up over time. If you take a very, very long-term view on the Canadian dollar versus the Norwegian crown, for example, and you plot the chart, you will see that it is highly mean reverting, which also fundamentally makes a lot of sense. Or when you look at the volatility futures, you see that over time, because of the futures decay, it's basically just a line that goes down on a chart. And this is something that they would call a structural edge, where you just know where long-term or mid-term the price is dependent of what the current fundamentals are. And I really learned that there's nothing more important than to have a structural edge and to really understand the asset that you're trading.
In our pre-call, you mentioned about part of the strategy, I believe, for yourself or at the fund, was to not reinvest the earnings so as to help reduce the likelihood of getting blown up by a black swan by continually compounding.